Hi, and welcome back to the Business Career College video series. In this video, we're going to look at the parties to the insurance contract and a little bit of details around the contract itself. This video will be helpful for those going through the Life License Qualification Program and for possibly people going through a financial planning course as well, especially if you're not familiar with insurance to a great extent. So with insurance contracts, we're going to have at least two and sometimes as many as three parties. The parties we have are going to be the insured, or we might also properly refer to this person as the policy owner or the contract owner. And then we're going to have, obviously, the insurer. And then we'll have the life insured. Now, in many cases, and I would argue in most cases today, the insured and the life insured are the same party. We also might refer to the life insured, by the way, as the annuitant, although that language is a little bit dated, but we do see that again when we talk about segregated funds. But it is by far the most common circumstance that we have an insured who takes out insurance on their own life. This is what we would refer to as a personal contract or a two-party contract. It's less common today, but it does sometimes happen that an insured enters into a contract where there are three parties, and that's where we would have the insured, the insurer, and a life insured. And this might happen where parent takes out insurance on the life of a child, or a business takes out insurance on the life of an employee. Now, when we look at these insurance contracts, we have a few terms that we have to define here. Insurance contracts are, first off, unilateral contracts. And this is a very important concept with respect to insurance contracts. A unilateral contract means that only one party makes a promise here. Only the insurer makes a promise. The life insured and the insured do not make any particular promise. The promise that's made by the insurer is that a benefit will be paid at the time indicated or when the event happens in the contract. The life insured doesn't make any particular promise about how they will behave. The insurer has done a fair bit of underwriting to determine what this person's behavior and health risks are going to be like, so the insurer is willing to take on that risk. And the insured also doesn't make any particular promise. Now, the insured is normally the one who will pay premiums, and if the insured does stop paying premiums, then it is true that the insurance will generally end, barring cash values and non-forfeiture options. But absent any of those provisions, yes, it's true that not paying premiums will result in coverage ending, but that's all it will result in. This is different from other sorts of contracts. If you enter into, let's say, a contract to acquire a cell phone and you want out early, the cell phone provider is still going to come after you for any unpaid fees with that cell phone contract, whereas with an insurance contract, you didn't make a promise. So it's important here that only the insurer has made any particular promise. This even applies to the concept of exclusions to life insurance policies. The only exclusion that we normally see on a life insurance policy is that an insurer will not pay a benefit if the life insured has committed suicide within the first 2 years after a policy is issued or reinstated. Other than that, it's very hard to find a circumstance where an insurance policy that's in force does not pay out its death benefit. And we often hear some bad information about this, but the reality is that life insurance contracts, your normal run-of-the-mill life insurance contract, does not exclude events like drinking and driving, or commission of a crime, or war or terrorist activity, or any of these types of events. The life insured makes no particular promise, but the insurer does a lot of underwriting to make sure that the life insured isn't the kind of person who's likely to be subject to those risks. Insurance contracts are also aleatory contracts. What an aleatory contract means is that we're not looking at the contract every day to determine how it should pay out. Instead, we're simply going to look at the contract when there's a claim. And that's the only time we're concerned about these contracts, is when a claim arises. And then, that's aleatory, sorry, that's an A in there. And then we're also going to look at the fact that insurance contracts are contracts of adhesion. And that means that we can't change terms in the contract. We're not going to cross things out and initial them or whatever the case is. The contract is the contract, and it's issued as written. Now, some of you are probably saying, well, hang on a second here. Shouldn't there be another party to this contract? Well, my insured is going to, hopefully, name a beneficiary. And there are a number of different parties that we can name as beneficiaries. And before we discuss who those are, I want to mention that we can do this one of two ways. The way that we generally prefer, at least initially, is in the application for insurance, but it is actually possible to use a will to make a beneficiary designation. The requirements for this are very specific and very explicit. The will has to be specific. We have to know for sure that we're making a beneficiary designation here, and there can be no room for any sort of doubt otherwise. And people have attempted to use their wills without effect to create beneficiary designations when their language has been unclear or ambiguous. And it generally holds that the most recent of these documents is the one that will hold up. So if I wrote an application for insurance and I named my beneficiary in that application, and then some years later I wrote a will naming a different beneficiary, as long as it was explicit and we knew exactly what I meant in that will would override my previous application where I had indicated who my beneficiary would be. Now, I can name pretty much anybody as a beneficiary. And it would be common to name a person, for example, your spouse or a child, as beneficiary. But if you're going to name your child, that person might be a minor. Now, minors under the age of majority, under the age of 18 or 19, depending on the province you're in, cannot receive death benefits. And in that case, you would have to name a trustee in order to receive that death benefit on behalf of that minor. The trustee is somebody who's going to look after those funds, somebody trustworthy, as the name trustee would imply, and that trustworthy person now makes sure that the minor is going to be taken care of with that death benefit. We can name a corporation or other sort of business structure as a beneficiary. We can name a charity, for example. It is possible that we name our estate as beneficiary, and usually we're going to name our estate as beneficiary where we're going to have what we normally refer to as testamentary debts, where we have things that are going to have to be taken care of, money that's going to have to be paid out as a result of our death that we don't trust anybody else to take care of. So testamentary just means a death. And if we know we're going to have these, it would be common to name the estate as beneficiary. It's not the only way to do this. There are alternatives, but that's one way to do things. And you absolutely should figure out what the exact best outcome would be in a circumstance where you're trying to figure out who to name as beneficiary. Now, when we name our beneficiaries, we can do this all kinds of ways. So I might name, let's say, 4 beneficiaries on my life insurance policy. Maybe I'm going to do something like this. Maybe I'm going to name 1 beneficiary to get a 40% share, and then 3 other beneficiaries to get 20% each. That's perfectly fine. There's really no restriction to how imaginative you can get with this, although if you get too creative, sometimes that can come around to bite you. And it's pretty common as well that when I name a beneficiary, I would name what we call a contingent beneficiary. And a normal provision you might see here is you might have a spouse who's taking out insurance on his own life for the benefit of his spouse and children. And he says, okay, I'm going to name my spouse as beneficiary, which makes a lot of sense. But we have to acknowledge that it's possible that the couple could die in a common disaster. That is, they both die in the same accident. And then if that happens, where's that death benefit going to go? Well, that's where we might name a contingent beneficiary. And maybe what we're going to do here is name a trustee who's going to take care of their minor children now. So it's quite common and generally wise to name a contingent beneficiary. We should also consider that in some circumstances, now this is not common and it's not something that is necessarily desirable, but in some circumstances, we might need to remove some of the ability of the policy owner to change their beneficiary designation. And in such a circumstance, we will name an irrevocable beneficiary. The irrevocable beneficiary cannot be changed without that irrevocable beneficiary's written consent. This would be a beneficiary designation that would be filed with the insurer. This used to be done between, say, husbands and wives, but really, if you're in a relationship where everybody trusts one another, this wouldn't be appropriate for the most part. Now, what you might see is this kind of thing, where we have a husband and wife here, and this husband and wife, they have something go wrong and they end up divorced, so now they're living separate lives, but they have some children. So they have child A, B, and C down here. And it's very common today, as part of a divorce agreement, that we would want to have insurance where if the husband dies, there'd be a death benefit paid to the wife, and if the wife dies, there'd be a death benefit paid to the husband. So what we might do here is we might have the wife own a life insurance policy, and maybe she pays her own premiums. The ex-wife now, I suppose. And then we want to make sure that if something goes wrong here, that the husband is going to get that death benefit so that he can use that to continue to take care of those children. So we might have the wife now name the husband as an irrevocable beneficiary. So she might make this irrevocable beneficiary designation, and likely this would be a reciprocal arrangement where the ex-husband also has life insurance, naming the wife as beneficiary, and she's also named as an irrevocable beneficiary. And then at the end of their support requirements to one another, we would free up those irrevocable beneficiary designations. Each would sign an agreement to release the other as irrevocable beneficiaries. I hope that helps. That's an overview of the parties to the insurance contract, and it does show us a little bit about how the insurance contract works and who's involved in this contract and where we have the different parties come into play. Enjoy your studies. I hope that's been helpful. Thank you very kindly.